Welcome back, everybody. My topic for today, stop using stop orders. This is your host, Dr. Paul Price, for Options Profits. What is a stop order? A stop order, by definition, is a market order to buy or sell a certain quantity of a certain stock if a specified price, the stop price, is reached or exceeded. A stop limit order is the same thing. It's in order to buy or sell a certain quantity of a certain stock at a specified price or better, but only after it's triggered by hitting that stop. So a stop order is essentially, a stop limit order is essentially a combination of a stop order and a limit order all in one. Why do people use stop orders? Well, some people believe that if a stock you own goes down by a certain percentage, you must be wrong about that stock. Otherwise, it couldn't have gone down that much. This could be true of options as well, and people use stops for both stocks and options. Stop orders will automatically get you out after being triggered, which in theory will prevent even bigger losses. Now you'll notice I said in theory. Why did I say that? Well, many times bad news is released after the close or before the close, and many stocks can have gap up or gap downs on the next day's opening. So a normal stop order would get triggered, turning it into a market order, but you would end up selling or buying right into that opening weakness or strength, well below or above what might be your stop price. So sometimes, even though you get triggered, you don't get the price you expected because it can be well below or above those prices because of gaps. Wouldn't a stop limit have worked? Well, let's take a look. I would say yes and no. You wouldn't have sold if it was a sell stop into that horrible opening if your limit was higher than the trading price, but you'd still be holding those shares unless they rebounded later to your limit price. That means you would have defeated the intent of the stop order, which was to prevent a larger than specified loss before you exited that position. So a stop limit has some benefit. It also has some negative. What if you were selling a car? Forget a stock or an option. What if you had a car that you had and you thought this car was worth $20,000, so you put it on the market for a fair price of $20,000. That was your best assessment of what that car is worth and should bring on the used car market. Now, the first person that comes along offered you $19,000 and you said, "No way. This car is a $20,000 car and I'm not taking $19,000." Fair enough. Now the next bidder came along and said, "I'll give you $18,000 for your car," and you still declined. You said, "Hey, I already turned down $19,000. I think it's worth $20. Why would I want to take $18,000?" So the third potential buyer comes along and says he'd only give you $16,000 for that piece of junk. What would you do? Well, in the real world, you'd probably tell him to take a hike. But if you're a stop order advocate, you'd probably say, "Of course, I'll take that bad price because you must be wrong in what I thought, I must have been wrong in what I thought the car was worth. So because you gave me a really bad bid, a lower bid than anybody else, I better take it right now because I have to be wrong." That to me doesn't make any sense at all, and I don't think it would make sense to you if you were selling anything but a stock or an option. So, why do you want to let others tell you what your stock or option is worth? When you use a stop order, it takes the thinking out of your trading. You're merely reacting to what others have already done in the marketplace. Doesn't necessarily mean they know anything about what it's worth. It just means that's what it's trading for. If you wouldn't sell at the price at the beginning when you first placed the stop order, it was because you thought that whatever you were holding was going to give you a better price. You also probably wouldn't be holding that stock or that option if you sensed that the risk was very high that it could go down significantly in price. So you've made a thoughtful decision that what you're holding is more likely to go up than down, and you don't want to sell it now because you think you can get an even better price. So why would you put a stop that said, if I get a really bad price, then I'm going to let it go? So what are our conclusions from all this? What do we take away from this discussion? Those who use stop orders are allowing other people to make decisions for them based strictly on share price movement, nothing to do with what anything is worth, simply because of action in the marketplace. A normal stop order may not get you out at the price you expected. Yeah, you'll get out, but it might be a much worse price if there's a gap up or down on that opening. Stop limit orders may not execute, so you won't get a really bad price, but you may not get out of something that you thought you're going to get out of. Market events such as flash crashes, natural disasters, political events can often trigger stop orders even though they have nothing to do with the particular stock or option that you're talking about. It just happened to the market, and then all of a sudden you're getting out or into something because of action that had nothing to do with the value of the thing you're trading. Using stop orders essentially removes the analysis component of your decision making. And I ask everybody, is there any other part of your life where you'd prefer to act without thinking about what you're doing before you take that action? That's my question to you. Only you can answer the question. Thanks for joining me again. This has been your host, Dr. Paul Price, for Options Profits.